If you're new to investing in Canada, the hardest part usually isn't choosing a stock or an ETF. It's knowing where to start. There's a flood of advice online: buy this ETF, open that account, time the market, don't time the market. And for beginners, it can feel overwhelming enough to delay action entirely. So in this video, we are going to simplify things. No speculation, no hype. Just a clear, practical, 4-step framework to start investing in Canada in 2026, even if you're starting with very little. Step 1. Understand what investing actually is. Before opening accounts or buying anything, it's important to reset expectations. Investing is not about getting rich quickly. It's not about guessing the next big stock. And it's not about constant activity. At its core, investing is the process of putting money into productive assets, like businesses, and letting time and growth do the work. For most Canadians, the goal is simple: outpace inflation, build wealth steadily, and reduce financial stress later in life. Once you understand that investing is a long-term process, everything else becomes simpler. Step 2. Choose the right account first. In Canada, where you invest often matters more than what you invest in. The 3 main investment accounts most Canadians encounter are the TFSA, the RRSP, and the FHSA for first-time homebuyers. For beginners, the TFSA is usually the best place to start. Why? Because contributions are made with after-tax dollars. Investments grow tax-free, and withdrawals are tax-free. There's flexibility, no penalties for withdrawals, and no tax surprises later. The RRSP becomes more valuable as your income increases, particularly when you're in higher tax brackets. And the FHSA is powerful if you plan to buy your first home in the next several years. But if you're unsure, start with the TFSA. It's the most forgiving and flexible entry point. Step 3. Pick a simple, diversified investment. This is where many beginners overthink. You do not need dozens of stocks. You do not need to predict the market. And you do not need complex strategies. For most beginners in 2026, the simplest solution is a globally diversified ETF. An ETF, or exchange-traded fund, lets you buy hundreds or thousands of companies in one purchase. Instead of betting on a single outcome, you spread risk across the global economy. Examples include all equity ETFs that hold US, Canadian, and international stocks together in one fund. This approach reduces risk, simplifies decision-making, and allows you to focus on consistency rather than constant monitoring. Step 4. Automate and stay consistent. This final step is where real wealth is built, and where most people fail. Consistency matters more than timing. Investing a modest amount every month automatically over many years almost always beats sporadic investing driven by headlines or emotions. Set up automatic contributions. Reinvest dividends. Ignore short-term noise. Markets will rise, markets will fall. That's normal. The investors who succeed aren't the ones who react the fastest. They're the ones who stay invested the longest. One last thing. Many Canadians open an investment account and never invest the money. They contribute, but leave it sitting in cash. That defeats the purpose. An investment account is only powerful if you actually invest inside it. Starting to invest in Canada doesn't require expert knowledge or perfect timing. It requires understanding the goal, choosing the right account, investing simply, and staying consistent. If you do those 4 things, time does the rest. Because in investing, the biggest advantage you can give yourself isn't intelligence or luck. It's starting early and sticking with it. If If you found this helpful, subscribe to Wealth Simplified, where we break down Canadian investing clearly, calmly, and without the noise.